Howdy there, folks, and welcome in. It's a buy one, get two free here tonight. 3 videos. Yes, not one, not 2, but 3 videos for me to react to here tonight and give my opinion on, okay? First video up here is discussing Meta stock. So Meta stock has made a sneaky 30% upward move in the past 1 month. So I want to listen to Stephanie Link's points in regards to Meta, and I want to discuss that stock in this video here today. I think it's very, very important, okay? Second video we're going to react to is the situation that's going on Wall Street with bonuses being in a bad place. And if you've watched kind of the market action recently, it smells like certain things that are going on, okay? And so we'll discuss that. I want to react to that video in today's video as well, okay? And then this one is freaky. Okay, this is scary. And this one I think is very important that everybody is aware of what's going on here. And I want to talk about that and I want to react to it because it's a very important subject. Blackstone limits withdrawals from real estate fund as inflows slow. It's a very important video. Anything in regards to Blackstone and also limiting withdrawals, it's an extremely important subject we have to be aware of, we have to be talking about. So I appreciate everybody joining me. As always, 19,600 plus subscribers at this point in time. Absolutely incredible. I've got a huge announcement for you guys, okay? Huge announcement. It's in regards to the private stock group. And, you know, I haven't even let the main channel know about this yet. I want to let you guys know first because I feel like demand's going to be insane for this, and I'm trying to just, put my toes in the water a little bit. And I figured also you guys are probably the most loyal subscribers out there, so I want to give you guys opportunity to join because we're going to have to, unfortunately, we'll have to kind of limit how many people join because I feel like based upon some of the price points and whatnot, it's going to be like ridiculous, overwhelming demand. Like some of these chats, I feel like it's going to be like insane, okay? So nonetheless, we'll have to likely put some limits on this, but I want to let you guys know first, before the main channel knows or anything like that, okay? We got some major changes to the private stock group, and basically we're opening up some, I guess you can say kind of like some opportunities that haven't been there in the past, because before you used to have to get on the phone, talk to somebody, then you had to join for a year. Some people only want certain things. They don't want the entire package. So I was like, let's go a la carte. And, basically, if you want in, you can join while we still got the spots open, okay? So what we're going to have essentially is if you just want the Tesla chat and you want to be part of the Tesla squad, plus get access to my portfolios, including my main portfolio and my dividend stock portfolio with screenshots every single week, and you get access to our full investor report. That one's right there. That one's more expensive than all the others, and the reason being is the Tesla chat already is our busiest chat, and at the end of the day, when it comes to Tesla chat, like we have a lot of major shareholders in there, and on top of that, a lot of Tesla employees, so I'm trying to make sure it doesn't get too out of control, because no one wants to be in a Discord chat where it's just like, brrr. We're always welcoming to some new shareholders and things like that, but I don't want that one to get too out of control. Let's just put it that way. We're going to have a Palantir squad chat. We're going to have a Meta squad chat. We have an Amazon squad, the Google squad chat, and then the AMD squad chat. So those you get access to whatever chat it is, and you get access to my portfolios to see all the moves I'm making, and you get access to our weekly investor report, which is just becoming a beast. It's just getting really good. And then also a la carte if you want the entire everything in regards to Discord chat, so access to my exclusive videos, my weekly investor report, the breadcrumbs tab, ability to join the 6 and 7 figure club, our earnings calls every Monday, things like that. Then you can check that out. That will be right here. If you want just the blueprint, which is every single one of my courses ever, okay, every single one of my courses ever, you get access right there. And then if you're looking for the total package, that is going to be right there, okay? So that will be pinned comment down there, and I'm excited to see some of you guys in there. Once you join, say hello, and I'll probably let the main channel know about this probably in the next day or two. So yeah, lots of that. Alrighty guys, let's get into this.
7% in 2022 and pacing for its worst year since '08. There are questions about whether tech can work in the new year. According to Altimeter's Brad Gerstner, the tech playbook for investors requires a newfound focus on the bottom line.
I think that you can either fight the last battle, which will be pretty painful, right? Or orient and position your portfolio for 2023. I think the things that you want to own, to the extent you're going to be investing in technology, need to be those beaten up names with real free cash flow support. There are big cap names trading at historical lows.
Yeah. All right. Hightower Stephanie Link is back with us. Hi, Steph. Good to see you again. No distractions. No other voices. I see you added to Meta this morning, which really is interesting to me. It seems to speak exactly to what Gerstner, who is a big Meta shareholder, is talking about.
Yeah, I've been suffering with Meta, as you know, all year long. But I do agree with Brad. I think that free cash flow in general for any company, any industry is super, super important. And I think with Meta, and by the way, I did add to it, it's now my largest position in the portfolio. With Meta, I think people think the entire business has gone south, right?
Did she say it is her largest position or it's not her largest position? That was hard to understand.
And I think with Meta, and by the way, I did add to it, it's now my largest position in the portfolio. With Meta, I think people think the entire business has gone south, right? And it really hasn't. They have a legacy business and they have Meta. And we don't know what about Meta. And I know they're spending a ton of money on it, but they do have a strong legacy business. And they do have size and scale in terms of monthly active users, daily active users. They're making tremendous strides in Reels with $3 billion revenue run rate last quarter alone. So they are making some progress there. I think they can monetize WhatsApp, and he even alluded to it. And then you have this big cost-cutting story, right? So they're going to cut 13% of their heads this year. And so expenses are going to go from 22% year-over-year growth to 12% next year. That has really positive implications, I think, for margins. And their CapEx is also going to go from 9% this year in terms of growth to 6% next year. So there's a lot of things that they can do to try to stem the tide, if you will, on the legacy business. So I think at 11 times earnings, the stock is super cheap.
Yeah, I mean, the PE ratio is just disgusting on this. The valuation is disgusting. I mean, it's pretty simple. Revenues are going up in 23, regardless of the economy. Net income's going up substantially. Margins are going up. They're pulling down expenses. Revenue will go up, right? And, I mean, the company's valuation is just a joke at this point in time. Wall Street's tried to send a signal to Meta that we want you guys to not spend so much on the metaverse. It's as simple as that. It's literally as simple as that. You see, as soon as they cut employees, what happened? Stock's up like almost 30% since then. Since literally the day they made that announcement, the stock's up like 30% or so, if not more than 30% since the day they made that announcement. Wall Street was just sending them a signal. You guys want to keep spending out of control? We're going to sell your stock off and we will sell it off massively and you will cut employees. And that's exactly what Meta ended up bowing down. They ended up saying, okay, yes, daddy, I will cut some employees. And that's exactly what happened with Zuckerberg and gang. I think if Wall Street didn't send that stock down as much, I don't know if Zuckerberg made that move, but he was really in a forced position that it was like, oh my gosh, the stock's trading under $100. We got to do something, guys. Then it was going to 80s. Like, we got to do something. Next thing you know, we're cutting 11,000 employees or 13,000.
I want your broader view because I know that we have a lot of viewers throughout the last year or two, perhaps even a little bit more, who got into a lot of those, high growth, high flying, high valuation tech stocks that have gotten absolutely creamed because many of them are unprofitable. I thought it was really an eye-opening statement to hear Brad Gerstner, who lives in this world of technology investing, suggest we are in the midst of a sea change where it's about positive free cash flow. And the other kinds of stocks those stories are kind of done. They may never get back to the levels they were and probably won't either from a price or valuation standpoint. Your view on that is what?
Yeah, no, I mean, positive free cash flow and also earnings and earners, right? And earnings growth. And so to me, that's what I focus on in general. It's very hard to value companies that don't have earnings. And when you start looking at price to sales and PEG ratios and this and that, it's very complicated. Momentum on the way up is phenomenal, right? But on the way down, there's no valuation support for companies that don't have earnings. True. So I think he is right. And I think that some of the names that he highlighted.
She just brought up a great point there. There's, when you're on that way down, for those stocks, it's like, how do you value it? Because almost everybody always values off of like positive free cash flow, right? Or net income. And so if you don't have either of those, then when you're on this like downward slope that we're on, right? You're in a situation and people don't even know how to value it. They basically put the value at zero. And that's the way you see a lot of these tech stocks. And that's why you see countless of these tech stocks down 60, 70, 80%, because people are like, I don't know how to value it anymore. And before it was just, I guess they were just on the hype at that time.
Were interesting. Some are still too expensive for me, Scott. In fact, most of the FANG names are too expensive. Meta is the only one that I think is interesting. We talked about Alphabet too. That one's on my radar. But again, I think you just got to be careful in terms of long duration assets. Because if you think like I do, that rates are going to stay higher for longer, that's going to be hard for long duration assets, technology in specifics, as well as growth stocks.
Yeah, Google's likely has a big employee cut coming, I feel like. But did you hear what she just said at the end of that right there? Did you hear what she just said? It was something very important. She was talking about long duration assets, right? And that it's hard to own those or impossible to own those because you feel like she feels like rates are going to stay higher for longer. And to that I say, are you really of the belief the economy can stay that strong for that long? And I think that's a fair question, because if you are of the belief that they will keep rates higher for a long period of time, then your belief is that the economy will stay strong for quite a while. And I think that's a big question mark. I think that's a big, huge, massive question mark, to be quite honest, okay? Especially when you see, obviously, the cost of debt is gotten very, very expensive and getting more expensive. Next up here, Wall Street. Ooh, let's talk about Wall Street and Wall Street bonuses, and then we got to get to some scary stuff with Blackstone there.
Oh, in the stocking for those who work in finance this year, right, Hugh?
It is, Contessa. Hey, how's it going? It is, particularly if you've been on the trading side at a place like Goldman Sachs. Let's say you've been a fixed income trader, and you just had a bonkers year. You really killed it this year. And as of the first 9 months of the year, trading revenue was up approximately 15%, 14% at Goldman Sachs. So you could be forgiven for sitting there and thinking that you were going to have an up year. Well, it turns out, you don't exist on an island. You are part of a diversified business model that happens to include things like investment banking, asset management, which are down 45 and 71%, respectively, year to date. And it's because of that. It's because of the pain in other parts of the Goldman universe, where the traders, we understand, are being told that, their bonus pool is looking to be down at least 10%. And that could, change as we get closer to the end of the year, and there's going to be push and pull with that.
What's your sense on how much this is because the companies themselves, these banks, think that they need to position themselves for whatever is coming in 2023? And how much of this is about the investors who are really celebrating cost cutting and belt tightening?
It's all of the above, I think, Contessa. I mean, to your point, 2023 doesn't look good. And, talking to management at several of the bulge bracket firms, there is pessimism about next year. It is going to be slow. There are projections of an economic downturn or recession. And in those scenarios, you don't see a lot of activity necessarily to do with IPOs, IPO window being effectively closed and remain shut. Trading is looking like, maybe it's not going to be as strong because for the most part, people have positioned themselves for the interest rate environment.
So first off, IPO is going to be very, very slow. That business for Wall Street is going to be extremely slow for 2023. However, don't think these folks won't make money if the market gets rough in 2023, if it goes back down, right? At the end of the day, they'll find ways to create massive volatility. And through that volatility, they can make tremendous amounts of money. Wall Street can make money on the downside, on the upside, but they love it. They love it when there's lots of volatility. The market we've had, especially recently, has been kind of boring. The VIX hasn't been super high. So for Wall Street, it's not actually ideal. So they'll shake things up. They'll shake up the jar in 2023. And they'll get things moving. They'll get some insane volatile moves in the markets, in stocks in general. And I think the big question of when does it come in 2023? Is it the first quarter, second quarter, or third quarter of 2023? I think that's a big question because one of those quarters, they will for sure shake the jar. And believe me, we will see that VIX spike up in an epic way. It's just the biggest question is what quarter is it? And I don't know the answer to that question, man. I don't really have an opinion on it because a lot's going to be dependent upon the economy and things like this, which are, do big things break? Let's get into this one.
Let's go there. Let's talk Blackstone because, we were the first to tell you about it yesterday. It's a story we've been covering for quite some time here, namely the growth of this B-REIT at Blackstone, a very important component overall of really their fee-related earnings at the company. In fact, this morning in a downgrade, Barclays saying as much as perhaps 20% of fee-related earnings related to that $70 billion portfolio of largely what is either industrial or rental assets, essentially. That's a downgrade we're seeing this morning. And this follows on what we told you yesterday, which is, and by the way, was part of the B-REIT fund from the beginning, but namely said, hey, you know what? If during any quarter more than 5% of our net asset value wants to
be repurchased. In other words, rebuy your interest back from you, or over 2% in a month, they have the right to say, all right, we can't pass through that. And so they put that out there yesterday. And there has been, Jim, just a torrent of sort of interest, I think, at least in certain circles about this. A lot of research this morning. Of course, I mentioned this downgrade from Barclays. Let's just give you a quick recap of what they had to say at Barclays, if we can do that. I'm looking for where my notes are there. Here they are. Yeah. We're downgrading equal weight, represents, as I just said, 10% of FEA AUM, but 20% of fee-related earnings, given the higher fee structure as well, and the profile of the product. So with redemptions now being limited at BREIT, they're increasingly concerned that the NAV may continue to decline as investors are likely to seek to recall their capital, and that may have a second-order effect resulting in significantly lower net inflows, right? Net inflows here were enormous. I was pointing them out. A number of reports over the last year. $3 billion a month back in the spring. That's incredible because it represented at that time. You remember where the 2 and 10 years were. You get five. Your RIA, high net worth broker.
Look, Barry Sterling had a.
Okay, before we listen to Cramer, y'all, Blackstone scares the crap out of me. It really does. I feel like what FTX represented to crypto, I feel like Blackstone represents that to the stock market and the real estate industry. It scares the crap out of me. When you go through so many various stocks and you see their number one shareholder, you see Blackstone come up again and again and again and again and again. It's like, holy smokes, is Blackstone the biggest investor in every single public company in the world, right? And you look at their real estate portfolio and you look at all this and you start to wonder, or have they become too big to fail now at this point in time? And if there was some sort of systemic problem with Blackstone, where do they start even selling off assets? Is it real estate? Is it stocks? It's stocks and real estate. Do they cause the whole market to crash? Does the Fed have to come in and bail them out? I can tell you they would. I think Blackstone's so massive at this point in time. I think they might be the most massive single important entity in the overall financial game. Bigger than JP Morgan Chase, bigger than Bank of America, bigger than Wells Fargo, bigger than any of those. It's rather startling. So when you see stuff like this, guys, it's very important to be aware of this.
Yes, S3
really backfired.
Here 5%. You're going to get some. You'll get some nice return. Also, we're going to increase net asset value.
Everybody needs to add Blackstone stock to their watch list. Add it to your watch list. Keep an eye on it over the next 6 months.
They have done that. They have increased net asset value, or at least certainly they have said they have increased net asset value. But there are concerns, or at least some question that, you're going to have to reverse that at some point, because when you look at, for example, the publicly traded REITs, the IYR as a representative of them, it's down. We know what's happened to many of these. Now, that said, they did a deal yesterday for this Vici, which will help them create liquidity, right? They sold a significant stake, Jim Grant, in the Vici deal. They did it above where their mark was, and it will allow them to meet further repurchases. Not yet, but when the deal closes, it creates more liquidity.
Too. Look, I want to just say point blank, if you read any of the, it's not even fine print, large print. We are not obligated to repurchase any shares and may choose to repurchase only some or even none of the shares that have been requested to be repurchased in a particular month. This is big print. This is not, David, oh my God, I didn't know.
Right.
This is like, okay, here's the deal. You may not get your money out the way you want to. So, the people who are in this thing, it was the most caveat emptor piece of paper.
But it also was a way to generate yield in a yield-starved environment. And it became, as the reason we talked about it so often was because it became such an enormous, one of the largest REITs out there in such a short amount of time. So a great product for Blackstone, helped to generate a lot of earnings at the company, but that obviously has changed.
Blackstone pretty much holds the most assets of just about anybody in the world, okay? So just think about this for a moment. I think this is very important for everybody watching this right now to understand, right? When you are potentially the biggest owner of assets in the world and asset prices start to decline, if they start to decline in a massive way, it could trigger all types of epic problems. And if your clients start obviously pulling out money, it could get messy really, really quickly, right? And never mind if you're leveraged up a little bit and here and there and here and there. Okay, it can get messy very, very quickly for something like Blackstone, which, like I said, I think it's probably arguably the most important financial related entity in the world.
I asked John Gray about it previously. He didn't really have too much to say.
And most people don't even think about it. Most people don't even know about Blackstone. Unless you're really in the financial markets, you would have no clue on how massive Blackstone really is. And the fact that this thing's as important, if not more important, than JP Morgan and the biggest banks in the world.
The last time we spoke about it publicly at our Delivering Alpha conference back at the end of September. But they do market every month. If you were able to get out in October, you may be benefiting as a result of that, because the mark's every month. And, we'll see where they are. They sold $5 billion in assets at a premium, again, to where they were being carried very recently with the Vici deal. They're managing the liquidity well. It's not an issue of that, but it is simply a reflection.
Do you think it's Schadenfreude? I mean, there was a lot of people like, I'm in awe of Jonathan Gray, and not only just for what he's doing here, but also for his charity. And I don't think this is kind of what you should have expected. Mortgage rates shut up a lot faster. I'd like to know who doesn't trust and thinks that they're going to default. I mean, isn't that what people are worried about? Is Blackstone default?
No.
Or it's just the rate?
It's just that, listen, it's not a great look when you don't let your clients get out. That's it. But it's not about anything more than that.
Okay, that's fair.
Yeah, we're not talking about
it. Yield's only 4.4.
Right. And it's not an expectation that many people didn't. Well, it was potentially something people had thought might happen here. And again, let's wait to see what some of the NAV is. All right.
Yeah, you heard him there. No one's expecting default or anything like that. It's a scary thing, okay? And I can just tell you, if assets continue to, let's just say, go down in a substantial way in 2023 for whatever reason, whether it's S&P 500, whether it's a Dow, whether it's real estate, I feel like there's going to be some sort of big systemic problems in Blackstone, and I don't even think anybody's looking at it right now. I really don't. I think they're starting to, but I don't think it's not like huge news yet, right? But the more concerns you have about liquidity when it comes to something like Blackstone, the more potential problems you can end up, having in a situation like that. And we watched that play out in the great financial crisis, no doubt about it, right? So, yeah, hope you guys enjoyed today's video. As always, I appreciate everybody for joining me. 19,600 plus subscribers now at this point in time. If you're looking to access any of our Discord chats and anything like that, definitely check it out, because probably tomorrow or the next day I'll do a big video on the main channel, and I'll have to likely limit numbers, because otherwise it's just going to be pure craziness in the Discord chat. Nonetheless, we can always use some more shareholders of different companies to chat with and whatnot, and to discuss. But I mean, yeah, I think it's going to be a little chaotic if once I do the big one, if I don't limit. So much love as always. Appreciate you guys, and have a great day.